Hello and welcome to Scale by Design. Today we are joined with Elizabeth Edwards. Elizabeth, welcome to the show. How are you?
I'm great. Thanks for having me.
Yeah, thank you for joining us today. And before we jump into the topics that we want to discuss, could you please share a little bit about your background with everybody?
Yeah, sure. So I am the managing partner and founder of H Venture Partners, which is a venture capital firm that backs early stage science-based consumer brands. So generally, we are one of the first checks in, if not the first check in, for companies that have some new active ingredient, new peptide for skincare, or material science for consumer packaged goods, packaging solutions, other science at the core of CPG. So I like to say that we invest at the intersection of biotech and consumer products.
That's really cool. And how long have you been with how long ago did you start H Venture Partners?
Yeah, so it was about 5 years ago, a little over 5 years ago, that I founded the firm, and I've been a venture capital investor now for over 17 years with a couple different firms before starting this one.
Yeah, that's really cool. How did you initially get into venture capital?
I started young. So I was a strategy consultant at Deloitte, working on front end M&A strategy, mostly for Johnson and Johnson. And so, as you're probably well aware, Johnson Johnson has a pretty big biotech and healthcare part of the business, and then also a CPG part of the business, so that their consumer health division. So I got to work in both divisions, and it was very cool. So I was working on medical devices and brands like Tylenol, and really fell in love with venture capital from the perspective of a strategic acquirer. So actually being on the other side of the table, talking to entrepreneurs about their technology, and how it worked and how it might fit into the J&J portfolio.
I love it. I love it. Very cool. And one thing that we discussed, bringing up today on the show is going through unit economics as you're considering companies and as you're working with your portfolio companies. So, I want to hand it over to you. It sounds like this is a topic that's top of mind. So maybe you
Yeah.
could just kind of lead us here and where do you want to start? Maybe we start high level on what's what outcomes you're trying to achieve, what is most important, and then we can dive into more like tactics and what people can kind of take away from the conversation, how they can implement it.
Yeah, so I think one of the hardest things for entrepreneurs, in this environment, where we're seeing a pretty marked economic downturn, and it's harder and harder to raise capital. Capital efficiency becomes really, really important. It's really always important, but it becomes more of a focus for investors because they're really focused on that burn rate. How much companies are spending and each month, and so one of the things that I think founders need to really keep an eye on throughout the life of a company is those unit economics. So a lot of times, startups, unfortunately, the SG&A, the overhead is always going to be a little bit bigger than you would like, because the top line is relatively small but growing. But where we as investors really need to focus initially is on those unit economics. And so we're looking at what are your costs of goods sold, what's your margin, your gross margin, what's your contribution margin, that delivered margin, and then how much does it cost to acquire a customer. And one of the things that I have seen in recent years that has really, I would say, squeezed CPG companies in particular is first an overspending on marketing. And there's a really great, benchmark out there that that VCs and founders love to point to, which is that your lifetime value of a customer, so your lifetime contribution margin for that customer over your customer acquisition costs, or LTV to CAC ratio, should be 3. And I would argue it needs to be 7. So the companies that I have seen that can really comfortably and profitably grow are usually north of 5. and in the best cases, 7 or above. And I think, what it really forces entrepreneurs to do is to think creatively about the definition of a unit. And we're always, pushing our portfolio companies to think about how they are acquiring customers. Are they acquiring customers one at a time? Or are they acquiring them in groups, of hundreds or thousands at a time? And how can they really grow their brand through creative partnerships where they can acquire customers a lot more cheaply? Then the other thing that I think is just, unfortunately, I would say a product of recent events, which is supply chain disruption caused by COVID over the last 2 years, which has really, increased the cost of goods. So if you're making anything that is a tangible product, whether it's oil prices or shipping containers getting stacked up at ports, those things have a real impact on the cost of goods. And so that's negatively impact margin for a lot of companies. And if you're a startup, you're already dealing with relatively low order quantities. So you're not going to have that, that great scale of larger competitors. And so it's really put quite a bit of pressure on folks in the CPG world.
Yeah, definitely. And I want to just circle back to something you mentioned is talking about profitable growth. Is that something that you're truly focused on for the startups that you're investing in? And just to clarify, you're typically, is it typically early stage companies?
Yes.
Okay. All right. So you're looking at early stage, you're actually looking at companies to grow profitably at that point in time, or is that like one of the requirements that you look for when you invest?
So we look for unit economic profitability. Definitely,
Okay.
we don't want to be scaling a company that has negative margins. So we need to see, even if it's a novel technology that maybe they're gonna have a negative margin on their first few orders, but very quickly, that gross margin, because of their order size, scales. But yeah, as a pre-revenue investor, no, I don't expect that companies are going to be profitable day one and on a net income basis. What I'm looking for is really strong unit economics that are going to ultimately drive growth and hopefully get them to profitability, probably sooner than most VCs would look to get to profitability.
So how do you determine that, right? Like when you're looking at, okay, unit economics at scale, right? At some point, they're going to break to profitability. How quickly are you looking for them to break to profitability? And what do you base that on? Is that, based on a revenue milestone,
Yeah.
or maybe like a time frame?
Mhm.
How do you decide, like, what are the metrics you use to decide that? And then, how do you decide like how quickly you need them to do that?
Yeah, I would say that the in the best cases, companies that are able to turn profitable when they reach that 10 million in revenue mark, that's a great for CPG companies. That's a great benchmark. But I would also argue, there are companies that can reach profitability sooner than that. It really just depends on how much R&D expense is required. It depends on how profitable their unit economics are. The unit economics that I described previously. And just how lean they can be. But generally speaking, I've seen companies, there's absolutely a pathway to get to profitability in most CPG companies by the time that you're 10 million in revenue, if not beforehand.
Right. And I think I like the conversation around unit economics, whether it's a VC backed company or even a bootstrapped organization, maybe a services firm similar to my own. I think it's pretty much the most important thing, because otherwise, you could potentially even have a profitable company at an earlier stage. And then as you scale, add additional overhead and become unprofitable. And you know, I think a lot of people confuse what scale actually is. And a lot of the times I think the emphasis on scale is like how much money you've raised or how many people you've hired. Like, okay, we've scaled from 100 to 200 people. It's like, well, no, you've just doubled your overhead. So what is the actual scale that you're achieving? And then that's really what's getting into unit economics to determine if this is truly a scalable business, right? And at what point are you going to be able to make that turn? So
Mhm.
I, I'm sure you've seen that too, right? Like people talking about scale, like, hey, we just, raised X amount of money, or we just, we just hired 500 engineers.
Yeah, I know. I hate it when people talk about, oh, we grew 200%, and there are no numbers behind it. Um, exactly to your point, if it took you an incremental 20 million of capital raised to get to an incremental 10 million of top line growth, that's not good. So
Yeah.
unless you are investing in a lot of R&D, or you are a biotech company, you're going through clinical trials. But for the companies that we are focused on, where they are commercial ready, or very soon to be commercial ready, so less than a year to get to some market, it should not be the case that they're raising 20 million to get to 10 million in revenue.
Okay. Got it. Yeah, that's very interesting. And I think one thing with the unit economics too, just getting down to customer acquisition cost and getting into more specifically marketing strategies, how much of your time is diving into go to market when you're evaluating companies? And is that something where, like, I'm also really interested in the concept too of like platform services from VCs in terms of either it's like, recruiting, talent solution, support, go to market, product development, roadmap. How much are you helping? Two questions. How much are you evaluating it when you're looking at an investment? And then are you also providing that strategic support? What's your kind of philosophy on providing support and evaluating go to market?
Yeah, it's a really big area of focus for us. So we spend a lot of time with our companies though across the board. So go to market is key because your go to market strategy, it's going to drive most of the spending, right? So what investments you're making, what risks you're taking, and who you're hiring. But from our standpoint, companies really need holistic help. And so our model is, all of our investors, with only a couple exceptions, being big institutional investors, all of our investors are experts in the space that we invest in. So they are retired executives of consumer companies who have 30 years of experience in supply chain or R&D or IP strategy, retail strategy. So to your point, part of that is a go-to-market strategy in retail, direct to consumer, et cetera, et cetera. And so we really surround those companies with a lot of resources, people that they can call on and get their help, looking at a pitch deck for a Target or a Walmart, or even getting an introduction to, any of the above, and thinking through which retailers even to approach first, and then second, and then third, and how that retail strategy rolls out over the years. So we really do need, all of the above. I would say IP strategy is pretty darn important. Supply chain strategy is pretty darn important, especially, in this environment. And so we do our best to help in all ways. For me, I mean, I'm spending time before we make an investment, even with the same group, evaluating all of those aspects. So that same group of experts really helps our investment team in the due diligence of companies that are high interest, high potential for investment.
Got it. And so when you're looking at that, I'm just curious, like how far along do you expect the founders to be in terms of their go-to-market strategy? Like for instance, if they just have a really fantastic product, but maybe they don't know a whole lot about go-to-market, are you willing to say,
Yeah.
okay, we're going to help you make the heavy lift here? Or is there like a certain level of competency that
Mhm.
you expect them to have in terms of, you're looking for second time entrepreneurs, or you're looking for somebody that had some type of, business experience on potentially even some, touch and go to market, things, maybe not directly, but at least involved. Do you look for that prior experience? Like how do you determine like how much of a lift that your team is willing to do for a company?
Yeah, so we're not in the business of running companies uh, for our CEOs, right? And so we do like to see companies that have a well thought out go to market strategy, but are open to collaboration too. Because if you start with something good, we can probably help you make it great. And so that's more of the approach. And it really ranges because we'll invest in companies that have zero revenue. We'll invest in companies that have 10 million or more in revenue.
Mhm.
And so that's a pretty broad landscape of companies. And over that time, they will have tried and proven different things. But I think at the pre-revenue level, we're looking for more experience, right? Because we have to have a reason to believe that this team is able to execute on a plan. So at the pre-revenue level, we want to see, great technology, a great plan, and some experience there to back it up. As companies prove more of their strategy, I would say that that need to see like the bona fides, in the CV burn off a bit, because if you've been really capital efficient and grown your company to 10 million in revenue, and and you're profitable, and you've got a really great plan, you've got a really great history of execution, well, it's less important that you have 10 years of experience, because you've already proven yourselves
Yeah.
in many ways.
In a sense, it makes it a little bit easier because they've already defined repeatable success, right? Um,
Exactly. Yeah.
Very cool. Very cool. And one of the things I wanted to, I think we probably got about 15 minutes left recording. So I wanted to talk to you a little bit about what we're seeing right now with down rounds,
Yeah.
seeing a bit of a bust in the market. It seems like we're in that part of the cycle. Companies are making, there's different moves companies have to make to survive, focusing more on profitability, sustainability, ensuring, customers aren't churning,
Mhm.
doing everything we can to sustain. So what are you seeing right now, and what advice are you giving to your portfolio?
What I am seeing right this moment, here as we sit, November 22, it's a really tough market for early stage companies that are burning cash. And I would say it's actually a really tough market for companies of any stage that are burning cash. Because as we saw, and we knew that this was coming, business cycles tend to, tend to go into, or I should say, a business cycle is usually, plus or minus 10 years. And we're kind of overdue for one. We've printed a lot of cash
Mhm.
to kind of stave off this particular recession. But um, I remember very well in 2008, being a venture capital investor then, and having 5 portfolio companies, were brand new portfolio that we were just starting to build out. And this was in '08. 3 of them immediately went out of business because they were seed stage companies, and they didn't have very stable cap tables. They had angel investors and us. We were the only fund, and those 3 particular companies. And so that really puts a lot of stress on the existing investor base to bridge through tough times. And so I tell entrepreneurs, in good times when you're raising capital for the first time, or just as a general rule of thumb, you'd love to see at least 3 deep pockets in the deal, and keep doing that over and over with each new round. If you've got a cap table that's too concentrated, so you have one set of deep pockets to go to in tough times, some big VC fund that that's most of the invested capital in the company. If you have a rough patch, or if a rough patch like a downturn, or a 2020 COVID downturn, if that hits, you don't want to have one investor to go to help you bridge through that time. Because if they say no, the answer is you're out of business. We'd much rather have 3 or 6 or 9, key investors to go to say, hey, we want to do a small bridge round just to get through this. Your piece of that is small. Can you support the company now? So this is a tough time when we see the capital markets move from a growth orientation to a profitability orientation as strongly as they did in January of 22 and continued to do. And we saw, massive layoffs start hitting in, April and May of 22. It really points to the need to respond to the market, which means you got to take the deal. I like to say you have to be present to win. If your company is out of business, you won't be around next year or the year after when things are markedly better and you can raise fresh capital at much better terms and maybe, re-up that employee option pool and start to re-earn some of the equity that may be lost in these crushing down rounds. And by the way, it's all relative. Like, these crushing down rounds are a result of a totally irrational market over the last, 18 months, if not more, where so much capital was going out the door at crazy high valuations. If you look at the charts of venture capital funding, you got to kind of take, the end of 2020, through the beginning of 2022 out of it, because 2021 and early 22 were bonkers. Those valuations didn't make any sense. And so while you might feel like, oh my God, I had a valuation of 40 million yesterday, and now they're telling me 10. Well, the answer was probably 20, but then it got,
fair enough.
Yeah, things go up, they come down. If you don't have cash, you're out of business. Take the cash at whatever terms, you can work it out later. You might not win the battle, but you'll win the war. So you got to be flexible.
Well, yeah. So, I mean, that actually makes a good point, because it's like, if you feel like, okay, this is down rounded, I'm not getting a good valuation. It's like, well, maybe to some extent it does even out because you got an insane valuation, 6 months ago.
Yeah,
raised.
absolutely.
So what are your thoughts on this then? I've talked with a couple of different people in the VC community who, one individual actually came on the show, and what he had mentioned is he advises companies that are raising venture capital, and that's really his business model. He helps negotiate terms and these types of things. And what he was saying is that it's actually, he would advise people against sometimes taking a maximum valuation last year, because he said it's potentially not setting you up for success, and you're more likely to hit a down round. And there might be some clauses in the agreement, your fundraising agreement, in which when a down round is raised, there might be certain terms that are obviously much more favorable towards the VC than the founders. What are your thoughts on that? Like, do you see that too? Like last year, do you think some founders would have been better off, opposed to raising as much money as they could at the highest valuation, maybe raising less money at a more reasonable valuation? Is that like a better strategy for founders? Or
I would say, look, if somebody is willing to pay an insane amount of money for your company, it's really hard not to take it. And
right.
It's really hard not to take all that cash. But to your friend's point, if you know that the valuation is bonkers, then you really do need to look at the anti-dilution provisions in that term sheet, which will tell you if there's a down round, Are we going to share the pain amongst the investors and the entrepreneurs, or is it mostly the entrepreneurs that are going to, bear that pain? For the longest time, in general, it was, broad-based weighted average. And so, everybody kind of felt the same pain. The other thing that I would say, though, I think the bigger danger, even than the dilution aspect, is if you raise a huge round at a bonkers valuation, and then take all that cash and throw it into a dumpster and set it on fire, that is the worst outcome. If you raise a huge round at a bonkers valuation, but then you're very careful about how you spend that capital, and when the market shifts towards profitability, you pivot and say, you know what? We are going to grow, but we are going to, every few quarters, we're going to go profitable because we're going to prove it to ourselves that we can. We're not just going to, burn all of this cash and pursue a growth at all costs strategy because we have the cash in the bank. Because when the market shifts, now that you're out of cash, investors are going to look at, what did you do with the 10 million that you raised last time? Oh, you set it all on fire. Okay, well, that's going to influence the terms and how I feel about putting capital at risk, because it's always like a risk return calculation that we're doing on our part.
That's honestly, for me, my company is currently around 30 employees. That's always been the hardest part for me. It's like when you enter this kind of down market environment where cash is not as easily accessible, right? How do you find the balancing act between maintaining an aggressive posture and conserving cash? This year has been the biggest challenge for me as a CEO. I hope I've done all right. I mean, we've been able to correct course and become profitable again. It's been very difficult. I think it's because to some extent it's like you want to keep investing and go to market and your revenue strategy. But then again, it comes a point where it's like, how much do you try to go against the current? Because it's very easy to spend cash irresponsibly. And as you said, burn cash. And particularly if you're in an environment where you want to raise again, then it's like when you're looking at CAC and these types of things, like what can you show? Yeah. And it's like you're totally screwing your metrics. So at some point it's like, how much do you want to fight against the current? And so I'm curious, kind of like that's, I don't even know if you have anything to add to that, but like, again, that's probably one of the hardest things that I'm dealing with this year is trying to strike the right balance between being aggressive, focus on revenue, focus on go to market, and then also saying, okay, we need to tighten our belt, lower expenses, and preserve our runway and cash and try to maintain profitability to ride this thing out so that we are in a decent enough cash position for when the market rebound hits that we can then deploy capital at that point in time to actually take advantage of the growth in the market. So that's hard. That's the hardest thing.
What you're saying is it is hard as a leader to completely change the paradigm, right? People, your employees, your investors, everybody signed up for a growth story during a growth focused market. But now we're in a profitability minded market. And can you, the leader, change your mindset and reset expectations and say, look, the market is doing this and we need to respond. And it literally is, it's literally like, trying to argue with gravity. The interest rate is what it is. You're not going to be able to go into a bank right now and say, I know that the Fed just raised interest rates another 0.75%, but man, just give me the money at the old rate anyway. That's not a thing. So for the growth minded CEO, I think one of the things that that you can measure and use as a guide to help you figure out how much to lean into any growth. Because what I would say is there's sort of a profitable stasis is your baseline, right? Which is we'll stay the same size in terms of revenue. So we're not growing and we're profitable and we're in this state of homeostasis. But if we want to start thinking about growth, let's think about unit economics, but also let's think about the payback period. Because a lot of people have, I'll give you a great example of this. If we're talking consumer products, the lifetime value of a tampon brand is generally, about, the max is about $5,000, right? Like women will spend about $5,000 in their lifetime on menstrual products of some type, right? And so it's going to be something south of that. The lifetime value is going to be something south of that. But that is over a lifetime. So if you're thinking about, that customer and how long she's going to be a customer, she's going to be the customer for decades. And probably the payback period on that marketing spend is going to be long. It's a long time to earn that back versus a Peloton bike, profitable on first purchase. I mean, I don't know where they are today, but back when I was an investor, back in 14, 15, 16, 17, easily profitable on, first purchase. And, you've got this really nice subscription, thereafter. But the payback period matters because if the payback period is not within the time frame that you will see the market shift back to growth. So let's say it's going to take, a minimum of a year, maybe even 2 or 3 years to get back to growth. Keep that payback period short. Keep it like within a 6-month window. Then okay, you know what? I am spending some money on growth, but I know it's going to pay back very quickly and it's worth it. And if that's not the case with the business model or, with this particular, campaign or business activity, don't do it.
Yeah. The other thing that we're doing is we are doing less experimentation on different ways to acquire customers. So when we, cash was flowing a little bit more easily, we were testing a lot. We were saying, okay, we have these channels that working. Let's do some different things here. Let's attempt these other channels. And now we're really honing in on, okay, what channels are producing the best outcomes, both in terms of, revenue in, payback period, these types of things. And for us, it's relationships, right? It's investing in podcast, which brings awareness, right? So we produce a couple of those, my content on LinkedIn, relationships going to, CEO dinners and VC events and these types of things, and just building awareness and brand is ultimately what is driving the most business. So referrals, these types of things, right? It's I meet somebody at an event, a CEO at an event, and his or her buddy is hiring, and it's like, oh, you should talk to James, right? And that's as a services business for my specific company, that's what drives most of the revenue. So we basically cut budget on everything else and just are focusing on the core strategy, which is it's very cost efficient. The downside to our strategy is that it's heavily reliant on me, right? So it's like, as we see when we get into a better market condition, we really need to build out more of a holistic revenue strategy that's not so heavily reliant on myself. But point being is that getting to what we know works, right? And then just cutting everything else and not focusing on experimentation, go to market right now.
Mm-hmm. Or running much smaller experiments. As you run more and more experiments, you see really the range, right? It used to be if you were doing a TV buy, that's pretty big minimum investment, right? And then these days, with streaming, actually, TV advertising a little bit more approachable. So, and I'm talking about CPG brands for, services. It's completely different.
Right,
So,
right.
yeah, in the good times, upwards of 30% of a marketing budget will be, reserved for experimentation. Definitely, like, the earlier a company is and the less they've figured out, the more experiments you want to run and really figure that out. And as you identify those activities that are getting you at least a 3 and now a 5, okay, a great, a 7x LTV to CAC or greater, then you focus on those and you cut, everything else that's less profitable or
Right.
longer to pay back.
So you're looking at LTV to CAC and then also payback, and you're trying to essentially balance those out, because you might have some things where the LTV to CAC is better, but the payback period is maybe not as ideal, given the fact that you're trying to maintain profitability or sustainability in the short term, right?
Yeah, like think
Yeah.
of, an equation where maybe you have an offering where it's $10 a month, and people stay on it for a long time. But if it costs you, $200 to acquire that customer, and that's even before you like think about like what's my margin on that,
Mhm.
$10 a month. Yeah, maybe you want to, rethink that versus something that's, a $200 acquisition cost and you're getting $1,000 of revenue in year one.
For sure, for sure. Well, this has been incredibly insightful. We're coming up on time here. I wanted to ask you real quick, if people want to follow you online, they want to engage with you, your company, what's the best way to do so?
Yeah, so check out our website. It's www.h.ventures. And I write for Forbes. We post a lot of the content from Forbes on our blog, on our website. And yeah, you can check out all of our investment criteria, reach out, contact me, contact our team via our website, or you can find me on LinkedIn.
Awesome. Well, Elizabeth, thank you for joining me today. And for everybody else tuning in, thanks for joining us, and we will see you next time.